Hey guys, welcome to episode 4 of Investing One-on-One. I'm Charlie, and today I'm going to be telling you how to manage volatility or risk in the markets. So, what is volatility? Volatility is simply how rapidly a given equity changes price. As I mentioned in the last video, stocks are typically the most volatile type of equity. Because they're only comprised of one company, when new news comes out, government decisions are made, or earnings are released, the price can change drastically. Equities comprised of multiple stocks, like ETFs or mutual funds, are typically less volatile, as, rather than one stock determining the price of the entire equity, the risk is spread out among a group. One important value to understand is called a beta value. The beta is simply a measure of how volatile a given stock or equity is compared to its market. The market can sometimes be general, like the S&P 500, and sometimes it can be specific, like the NASDAQ for a tech-related equity. For a stock, a beta value of 1 would mean that the stock is exactly as volatile as its market. That would mean that for every $1 of price change that the market experiences, the stock would be expected to change $1 as well. If it has a beta value of 1.2, for every dollar of change that the market experiences, the stock would be expected to change $1.20. Your portfolio is your collection of financial assets. These assets could be ETFs, stocks, mutual funds, or various other asset types. Although I said more stocks in a group generally means less volatility, beta values of individual stocks are important to consider as well. If you have a larger group of super high beta stocks, it still may have a higher beta value than a single low beta stock. When building your portfolio, volatility is a very important thing to consider. If you want to maintain safe, steady growth, you want a portfolio with a low beta value. And if you want an opportunity to experience high levels of growth, you want a portfolio with a higher beta value. Diversifying with different types of equities can allow for more safety and less volatility in your portfolio as well. If stocks are taking a hit and mutual funds are doing well, your portfolio won't experience as much loss as a whole. So, to review, more equities and equity types typically result in less volatility in your portfolio. To minimize significant price changes, you should own many different types of equities, like many stocks, ETFs, and mutual funds. Thanks for watching. I hope this video helped you to understand how to manage volatility in the markets. Watch out for my next video, how to find and evaluate stocks with room for growth.